Welcome back to CFI, Credit, Finance, and Investing. In today's video, we're going to talk about building credit. So before we get into that, let's talk about a few things as far as why someone needs credit. There are rumors out there on the internet about people going off the grid or not needing credit, and if you can, well, that may be phenomenal for you. However, for most people, it's just not going to be realistic. So, for example, if you ever want to or need to rent an apartment from a property manager and now more and more private landlords, you're going to need credit. They will run your credit reports, see if you have a history of paying people back, and that is one of the primary determining factors of if they will rent an apartment to you or not. Another reason is if you want to get a cell phone that pays in arrears. Most of the plans that you see advertised for cell phone providers will require that they pull your credit and see again if you've paid people back before. Many times after you rent an apartment, you'll need to hook up your utilities. And a lot of the utility providers will also check your credit to make sure that you don't have collections from other utility companies. Again, because if they're going to provide services, they want to make sure that they will get paid for those services. Home loans. If you ever want to get a home or a car loan, credit will be one of the primary factors that will determine if you get a home loan and how much you will pay for that home loan, both in terms of a down payment and in terms of interest rate, and sometimes the amount of money you get charged by the loan officer or the bank who is giving you that loan. The other factor that you will be able to look at as you get further into your credit experience is the type of credit cards that you may qualify for. There are basic starter credit cards that usually carry higher fees or terms or rates, and then there are other credit cards that provide rewards, or sometimes they will pay you to switch credit cards. And also with a high credit score, you may get offers from banks or other places that will save you money if you're able to qualify for those cards. So keeping a good credit score and keeping a good credit payment history can dramatically affect your financial life. So let's understand what goes into a credit score. Let me turn on my screen here real quick and we'll talk about the makeup of a credit score. This comes from a website called myfico.com, and it talks about a lot of different pieces of credit and how scores are calculated and whatnot. But for today's video, we're going to focus on this graph that shows the makeup of a credit report. So you can see here there's some ancillary factors that affect it. There's 10% of your credit report would be determined by new credit, new accounts that you have opened. 15% of your credit would be determined, and this is looking at your credit score as a whole, but 15% of your credit score comes from the length of your credit history, or the time that you have had credit available on the report. Can they look back and see that over 10 years you have paid as agreed? Over 5 years have you paid everything as agreed? And then 10% is the credit mix, and by credit mix they mean things like what goes into it. Is it a credit card? Is it a car loan? Is it a home loan? Is it installment or revolving? And the difference between those two is installments mean you have a fixed number of payments over time. Revolving means it's a credit card where you can charge things and pay them off, charge things and pay them off over time. So these three here make up 35% of your overall credit history. By far the biggest impacts to your credit report or to your credit score are the amount owed, which makes up 30%, and the payment history, which makes up 35%. So creditors want to see, do you pay things back on time? Have you ever had a payment that is more than 30 days late, is typically when they start marking things late? And have you always paid things back over the course of your loan? They'll look back generally as far as you can. Landlords a lot of times will want to see at least a year history. Mortgage lenders at least a year to 2 years history. And again, they're looking to make sure that you have paid things on time. Other factors that go into that are collections or judgments or other items of public record, like liens that may be filed against you, just again to make sure that you're paying things on time. The amount owed is a little bit ambiguous. Now, that is not just looking at, hey, does he owe $10,000 in a car loan or a credit card loan? That's looking at the amount owed over time, the amount owed versus the available credit that you have available on your trade lines to you. So if you have a credit card that offers you a $10,000 credit and you only have a $2,000 balance, that would look better than someone that has a $10,000 available credit and a $10,000 balance. Or worse, if you have a $10,000 credit available to you, and maybe you got a little bit late and now your balance is $10,300. That will dramatically affect your credit score in my experience. So as we get into this, let's talk about some of the things that may hurt your credit if you were to start building it. One of the things that people will look at, and the credit scores look at, and lenders look at if you're looking at a car or a home loan, is the number of inquiries you have. There are two types of inquiry. The first type of inquiry is what's called a soft inquiry. Now, I've got a graph here from Experian, and Experian is one of the credit reporting agencies that actually issues a credit score. And it talks about soft inquiries. And a soft inquiry would be something like your employer pulls your credit before they hire you, or one of your existing creditors wants to update your credit score, or if you have a disclosure type thing. So for example, some credit card companies will buy lists and they will search against the credit score filters. They'll say, we want a list of people with 620 credit score and have 30% credit utilization so that we can issue them a pre-approval on their credit card. That would be something that would be a soft inquiry. It would not hurt your credit. Pre-approvals of any kind, if you go in and want to get pre-approved for a loan, they may use a soft inquiry. If it's a mortgage loan or a car loan, chances are that would be a normal or a hard inquiry, and those do have the ability to impact your credit. The reason those can impact your credit is it appears, so for example, when we were looking at mortgage loans before, if someone would come in and they had 10 inquiries, you know that they're shopping the loan, which is not necessarily bad, but it also may look like they're applying for multiple lines of credit in multiple places. One of the things that we used to see as fraud is someone would go apply for a mortgage loan at one loan broker or bank, and then they would apply for a mortgage loan at another loan broker or bank, and they would do that several times, and sometimes they would try to close all those loans simultaneously, and then the lenders don't have an idea of how much someone actually owes, which can actually really impact if they can pay the loan back. So hard inquiries can affect your credit if you get too many of those. A question that I get asked frequently by people who don't have credit is, how do I get started? How do we build this magical credit thing? Because there is a lot of mystery almost to it, and it's not something you're taught in school. They may mention it, they may have little pieces around it, but generally there are no alternative options to find out how to build credit other than researching it from people on YouTube or Googling it or whatever you may have to do. So the first way that people will start getting credit is with a credit card from a credit union or a secured credit card lender. I've pulled up the website for one of the local credit unions in the Midwest, Mountain America Credit Union, and they have a few different options and you can apply right there. What I would recommend doing is if you have an account with a credit union, and I say credit union because credit unions are usually a little bit more flexible than the big banks. A lot of people, if they have an account with the Bank of America's or JP Morgan Chase, it's harder to get started with credit than it is if you have a local credit union. Small regional banks generally are the ones that offer the credit cards that will get started, and similarly they actually are the ones that offer more flexible programs for some of the other financing like commercial lending. The smaller and local banks are the ones that will generally offer the better options for that. So you can see that there's a lot of different options within the credit cards, and what I would recommend doing is if you have an account with a credit union, apply there first, especially if your account has been established for an amount of time, and if you have not had collections or NSF payments or anything like that where you've bounced checks or not had the money in your account to cover the debits that you've put out there, they'll generally issue you a credit card. It'll usually have a lower credit balance, like $500, and that's fine. The main thing that you need to make sure is that they report to the credit rating agencies. That's a question that you need to ask. There are some companies, some banks, some credit unions that do not report unless you're late, and you need to make sure that they report every single month as long as you have a credit card with them. Sometimes people aren't able to get those type of loans, and a secured credit card is an option for you there. What a secured credit card usually does is they have you give them a deposit, and that deposit equals your credit limit. So if you give them $200, they will give you a $200 credit limit, which really isn't a credit limit, but it's a good way to start if you don't have other options. Now, this is Discover, and I'm not recommending Discover by any means. The reason I pulled this up is I wanted to show you a few of the options that they have. Now, annual fees are something that are very common in secured credit cards. The secured credit card lenders a lot of times know that people don't have any other choice, and they don't want to let that go unpunished, and I say that facetiously, but they will charge annual fees. So there are options with no annual fees for a secured credit card. You have a refundable deposit if you make your payments on time, of course, and if you replenish that deposit. The other major thing that you want to see is, do they report to the three major credit card the three major credit bureaus? I have seen, again, secured credit cards where they do not report to the credit bureaus unless there is a late payment, and that doesn't help you at all. There would be no reason to continue having a secured credit card if they're not helping you build your credit. The ultimate goal is to have your credit stand on its own, to where you can have a credit card and not have to have any of this stuff, secured credit card type requirements, and you will be able to then leverage that to build up additional credit. If after looking into the credit union or the small bank credit cards or a secured credit card, you're not finding any options there are a couple of other things that you can do to build credit. So for example, some property managers, if you're renting an apartment, will offer a package, they'll call it, but they will offer an option where it may cost you a little bit extra, and I have seen some that do this just automatically without charging. They will report your rent to the credit reporting agencies. This is a mixed bag. It's good and bad. It's good if you pay your bills on time. It's very good because then you'll have a trade line, is what they call it. It's a line of credit or a line that you have actually utilized, showing you make payments on time. It's bad if you don't make your payments on time, because then that will report on there and it will dramatically hurt your credit score. So as with anything where you're financing something, or where you're borrowing money, or you're exchanging money for a service like rent, you need to make sure you make those payments on time. That will always help you when you're looking for credit. Now, if you're not able to get credit in one of those situations, something that you can do also is become what's called an authorized user on someone else's credit account. This is a big risk for whoever adds you as an authorized user on that account, because if they give you a credit card and you make a late payment, it not only affects your credit, it affects their credit, and it affects their credit score generally for a few years. The credit agencies may say it's less than that, but I have seen it hold someone's credit down for a number of years after just a single late payment. And then, of course, like I've touched on a number of times, make your payments on time. Don't let things go to collections. Medical bills, a lot of times if you don't pay those, will go to a collections agency, and that collection agency will report it on your credit report as something like a late payment. That will bring your credit score down. Judgments will bring your credit score down. Now, what kind of things can go to judgments or to collections? Well, I've already mentioned medical bills, but rent and damage to apartments. If you move out of an apartment and you didn't pay your rent on time, or you had a deficient balance, or if you did not keep the property in good shape and the landlord had to fix it up out of pocket without your deposit covering that, they a lot of times can and will submit that to collections, and that collection will go on your credit report. It ultimately could go to judgment, and that's a topic for a whole separate video. Other things that can affect your credit: tax liens. If you do not pay the government, whether it's federal or state, and it goes to a lien status, a lot of times, in fact most times, that will be reported to your credit report, and that will bring your credit score down. Something else that we have seen in a number of states is child support. If the child support is not being paid on time, the state has the ability then to report that to the credit agency, and that will hurt your credit scores also. So credit has a lot of benefits to you. The higher your credit score, usually the less you will pay over time via interest rates, fees, and other options. With credit cards, it can also bring additional benefits. There are some credit cards that will offer reward points for airlines, or for cash back, or for hotel rooms, allowing you to travel at discounted rates. So keeping your credit solid, keeping your credit score high, gives you more and more options, and it doesn't matter how much money you make or how rich you are. Credit scores are completely independent of that. So to wrap up this video, I did want to go through a few myths, and this is coming from the CNBC website, and there are a lot of misconceptions out there. So we'll touch on the different myths that they bring up, And the number one is checking my credit score lowers my credit score. And they say this is false. Now, generally speaking, if you do it through the one credit report a year that you get for free, that would be accurate. That would be false that it lowers your credit score. However, if you pull it frequently, and there are some services that offer you the ability to check your credit report for a fee, that can hurt your credit score because it may come across as a hard inquiry. So we'll give their rating of false a mixed bag here. Checking my credit score lowers my credit score. Generally speaking, that's false. However, it could be true depending on how you do it. Carrying a balance on my credit card boosts my credit score. They rate this as false. Now, I'm going to again give this a mixed bag, because if you carry no balance ever on your credit score, you will have no utilization. And when you look at credit reports, and we'll do this at some point in another video, but it'll show you the ratings on your credit report. And sometimes it'll be a C that rates across for the number of months. Sometimes it'll be ones showing paid as agreed. But also you'll have dashes that show no credit utilization. So if you never use it, it may impact your credit score or may not give you the benefit that you're looking for. Also, if you carry a full balance, meaning if you have a $1,000 available credit and you always keep your balance at $1,000, that gives you a high credit utilization, which does hurt your credit score. So again, this is a mixed bag. Carrying a balance generally doesn't hurt your credit score if it's a low balance, or if it's less than, let's say, 50% of your credit score, or if you pay it off monthly, that will not hurt your credit. But if you carry a high balance or you never use the credit score, that could hurt you or just not give you the benefits of improving your credit score. My income, the next myth, impacts my credit score. And that's false, and I would agree, that is false. Your income has nothing to do with it. It has more to do with your credit history and how you use your credit. A good credit score means you're rich. This is absolutely false, and I agree with CNBC. I have seen a number of mortgage loans or mortgage applications where people would come in and they would have very little income and they would have excellent credit. As long as you're paying your bills on time and you're utilizing credit responsibly, it has nothing to do with your income. A perfect credit score doesn't really matter. They call this true. And I would say that is accurate to a certain extent. Very few people, in fact, I have seen very, very few, maybe one or two, that have a 850 credit score. But good credit scores do matter. 800 plus will get you in that elite club, so perfection is not necessary, but making sure that you have a perfect payment history is very important. Here they talk about 760 and above, and I would say 760 and above will help you in the majority of cases. There are, when you're applying for certain loans, there are what they call add-ons or hits to the rate for credit scores at certain tiers, and 760 may not be high enough to make you miss all of those hits. So the higher you can get, the better, but don't beat yourself up if you don't have 850. Just try to, again, make your payments on time, stay as clean as you can, and your credit score will be fine. Next myth, I don't need to worry about my credit score until I'm older, and this is absolutely false. I agree with CNBC. The sooner and younger you can get your credit score up, the better, because it opens up options. You never have to use credit. You're not obligated to use credit, but it does avail you options that you won't have otherwise. So the younger, the better on that. Paying off debt increases your credit score. Their rating is true and false, and I would agree. Paying off your credit cards can improve your credit score by all means, but if you never use credit, then it will not help you. So paying off debt, just use it responsibly and understand that it does help you, not always in the credit score category, but not owing someone money frees up you to do what you want to do. You're not tied into having to make payments to them every single month. My employer can see my credit score. They give this a false, and I would say that's not entirely true. In most cases, when you apply for a job, they may or may not be able to see your credit score. It really depends on what kind of credit report they pull and what you authorize. So again, when I was in the finance world, we would see people's credit score when we'd pull it, but in other job type situations, we wouldn't. Landlords, again, it also depends on what type of credit report they pull. Landlords usually will see the credit score. Some employers will also have the authorization to repull credit at different intervals, and that can be especially true in the finance world or in other worlds, in other job categories where credit or finance is part of the job. So I'll give this one a mixed rating. Generally, I would say it's more true than false. Student loans don't affect my credit score, and I agree this is absolutely false. Student loans do get reported to the credit bureaus. They also cannot be discharged generally in a bankruptcy if it's a federally subsidized student loan. And if you default on a student loan or don't make payments on a student loan, that will absolutely affect your credit score. Another thing I have seen with student loans that affect credit scores is the balances. We talked about credit utilization. Many student loans are deferred over time, and as the balance grows, of course, that increases your credit utilization. So student loans are something that do impact your credit score very significantly. I wish in our country we would put a higher impact on understanding student loans and in fact making people qualify for student loans more stringently. Not because students shouldn't get loans, but because many students don't understand the type of loan or what the loan looks like when they get it. They're handed out very simply by a financial aid department without explaining the impacts of those loans and how much money people will have to pay back over time. Next myth, getting married will merge my credit score with my spouse. And they've given this a false. Now, well, technically that is very accurate. It's false. Many times married couples merge their credit liabilities. So they will apply for credit cards together, or they will apply for home loans together, or car loans together. And while that does not merge credit scores, the credit that builds those scores or takes away from those scores will be merged. So the couple's credit scores will become closely synchronized depending on how they make payments. Now, as a married couple, you can apply for credit separately. You can keep your credit separate, and then that will make their answer here a false accurate. 11, using debit cards helps build a good credit score. This is absolutely false. I agree with CNBC. Debit cards have nothing to do with credit unless there is a component at the issuing bank that reports the transactions to credit, which would be very uncommon. I believe they exist, but again, very uncommon. So even running things, when you swipe your debit card, sometimes you can run it as credit. That doesn't build credit. All that does is use it as it processes it differently through the transaction, meaning it doesn't necessarily come out of your bank right away. It may take a couple of days, but it has absolutely no impact on credit. Closing a credit card improves my credit score, and they say false here. And that would generally be accurate. Generally, when you close a credit card, it reduces your available credit. And remember, if we go back to the chart here about how FICO scores are calculated, you have the amounts owed is one of the pieces. Well, and that has to do with credit utilization. So if you have the available credit and your available credit goes down because you close a credit card, then that could impact your credit score. However, in my experience, it doesn't generally impact your credit score, especially if you have multiple trade lines open or multiple credit cards open. One thing that we would look at in the financing world is if someone has 15 credit cards open, that's a lot of available credit, and we don't necessarily like that. So if you have 3 or 4 trade lines, so you have 1 or 2 credit cards, you have a home loan, and that's it. That's 3 trade lines, and that's it. You don't necessarily need it. So closing a credit card does not necessarily improve your credit score. Something that I would be very worried about if you have multiple trade lines open or multiple credit cards open that you're not using is your credit getting hijacked. Someone there are people that are able to get into and steal people's credit identities. And if you have a credit card that you're not using and they see there is no utilization on it, it is not unheard of for people to be able to hijack an open trade line and open new ones, of course, too. But that would be something I would be very worried about, and just leaving credit cards open forever. And we already touched on this one. Selecting credit when using a debit card purchase helps raise my credit score. Of course, that just doesn't happen. So I hope this video has been useful. If you have any questions, please leave them down below. If this video has helped you or has provided valuable information, feel free to share, like, comment, or subscribe. Thank you very much for being here.